All right, today we're diving into one of my favorite tools for any trader, the triple bottom. You know, it's this classic chart pattern that's basically a giant flashing sign telling you that a falling market might just be ready to turn around. So let's get into it. I mean, we've all been there, right? You're watching a price just fall, and you're asking yourself, is this it? Is the bleeding finally gonna stop? Honestly, trying to catch that exact bottom can feel totally impossible, kind of like trying to catch a falling knife. Well, what if the charts could give you a massive hint? That's pretty much what the triple bottom pattern does. It's a formation that tells a really clear story. The sellers are getting tired, they're running out of steam, and the buyers are finally waking up and ready to fight back. It's one of the most solid clues you can get that a big change is coming. Okay, so how do you actually spot this thing in the wild? In this first part, we're going to break down its basic shape so you know exactly what to look for on your own charts. At its heart, it's pretty much what it sounds like. You're looking for three distinct dips, or bottoms, that all slam down to about the same price level and then bounce back. This triple rejection is your first huge clue that the sellers, who've been in complete control, are starting to lose their power. So now that you've got the basic shape in your head, let's get a little more granular and look at the anatomy of this pattern. Because to really trust this signal, you've got to be able to identify each of its key parts. First up, and this one is an absolute deal breaker. A triple bottom only counts if it happens after a clear downtrend. You gotta see a period where the price has been falling for a while. It's a reversal pattern, right? So it needs something to actually reverse. Makes sense. Next, you've got the main event, those three lows. So the price drops to a point, buyers step in and hold the line, and it bounces. Then it happens a second time, and then the third. This repeated defense of a single price zone creates what we call a really strong support level. And finally, we have the trigger. See those two little rallies that happen between the three bottoms? They create two little peaks. If you draw a straight line connecting those peaks, you get what we call the neckline. Just think of this as the final wall that needs to be broken. A solid move above this line is the confirmation you've been waiting for. So, to quickly recap, here's your checklist for a valid triple bottom. You need three lows at roughly the same level. That creates your strong support zone. Then, here's a pro tip many people miss. Look at the volume. As the pattern is forming, you ideally want to see trading volume start to dry up. That's a huge sign of seller exhaustion. And lastly, when the price finally breaks through that neckline, you want to see a massive surge in volume. That's the market screaming that the buyers are back in charge. You know, it's also pretty helpful to see how this pattern compares to its cousins. The triple bottom is a bullish or buy signal, a lot like the double bottom. The big difference? Many traders feel the triple bottom is more reliable because that support level held strong 3 times, not just twice. And its exact opposite, its mirror image, is the triple top, which is a bearish signal that tells you an uptrend might be finished. But you gotta remember, a chart pattern isn't just lines on a screen. It's a story about human psychology, about fear and greed. So now, let's get into the story behind the triple bottom, which is really a tale of 3 failed attacks and a major power shift. This quote just nails it, doesn't it? At its core, this whole pattern is about one side of the market just getting completely gassed. It's a 3-act play about exhaustion, and it unfolds right there on your screen. And here's how that play unfolds. Act 1, the sellers are feeling confident, they're in control, and they push the price to a new low. But then, buyers show up and defend that spot. Act 2, the sellers try again, pushing down to the exact same level, but they fail again. Now you can feel the doubt setting in. Act 3, this is their last-ditch effort. When they fail for a third and final time, it's over. They give up. And that's the moment the buyers completely take over, smashing through the neckline and kicking off a brand new trend. So understanding the what and the why is awesome, but the real question is, how do you actually trade this thing? Well, let's walk through a super simple step-by-step playbook you can use. Okay, the most important thing here is to have a plan. First, make sure all the parts of the pattern are there. Then, and this is so important, don't jump the gun. Wait for the price to actually close above the neckline. That's your signal to get in. For your safety net, you place your stop loss just below that support level. And to figure out where to take profits, just measure the height of the pattern from the lows to the neckline and add that distance to the breakout point. It's that simple. Let's make this concrete. Check out this real-world example on the dollar-yen currency pair. You can see that after a nice downtrend, the price came down and tested the 138 level not once, not twice, but 3 separate times. The bounces in between created a perfect neckline right at 141. Now, for our target, We just measure the height of the pattern, right? So the distance between the neckline at 141 and the support at 138 gives us a height of 300 pips. So we just take that 300 pip height and project it upwards from where the price broke out at 141. And that gives us a price target of 144. And what happened? The price broke out, kicked off a new uptrend, and went straight to the target. A perfect textbook trade. Now that all looked pretty clean, but let's be real. Trading isn't always that easy. No pattern is foolproof. So for this last section, we have to talk about the risks and about this pattern's evil twin. So the good stuff, this pattern gives you super clear levels for your entry, your stop, and your target. And it works in just about any market. Stocks, Forex, crypto, you name it. The catch? Man, these things can take a long time to develop, so you gotta be patient. And you always have to watch out for a false breakout. That's when the price pops above the neckline just to trick you, then falls right back down. And here it is, the mirror image, the triple top. It's literally the exact opposite. It shows up after an uptrend, has 3 equal highs, and it's a signal that the price might be about to fall. So while a triple bottom tells you to think about buying, a triple top screams, look out below. So, as you can see, the triple bottom is so much more than just a shape. It's a story playing out, a story of a battle between buyers and sellers. It shows you the exact moment when one side is completely exhausted and the other is ready to take control. So the only question left is, now that you know how to read that story, how are you going to use it?